I want to tell you about a client I will call Sarah. Sarah had been running her business for about 4 years when she came to us. She was doing well, consistent revenue, a team she was building, and a business she had built from nothing and doing well. She had an LLC and a CPA. And as far as she knew, she was set up correctly. When we did her annual check-in, one of the first things we looked at was her structure. And what we found was that Sarah had been sitting at over $150,000 in net profit for over 2 years, paying self-employment tax on every single dollar of it. And nobody had ever told her she was ready for a different conversation. When we ran with the numbers on what an S Corp election could mean for her going forward, she got quiet for a second, and then she said, "Why didn't anyone tell me this sooner?" And we hear that question a lot. And the honest answer is, it's not that your CPA made a mistake. It's that this particular conversation requires someone to be proactively looking at your numbers throughout the year, asking you the right questions. And that's why we've created our tax snapshot and annual tax check-in. This moves the filing relationship to a transformational relationship. And that's what today is about. Welcome back to CEO Numbers Network. I'm Danielle Hayden, and this is the second episode in our tax series. Today, we're going to go deep on one of the most impactful areas of our check-in, your business structure. We're talking about what self-employment tax actually is and how to know if you're ready for an S Corp and what changes when you make that move. It includes payroll, benefits, and reasonable compensation. There's a lot there, and I'm going to walk you through all of it. Let's start first with self-employment. To understand why the structure matters so much, you first need to understand self-employment tax. This is where a lot of money is leaving the business owner's bank account without fully understanding or realizing what you're paying. When you are an employee, your employer withholds taxes from your paycheck. Half of your Social Security, Medicare taxes come from your check, and your employer pays the other half on top of your wages. You never have to think about it. Like, when we were an employee before we started our business, you didn't think about this. When you are a business owner operating as a sole proprietor or an LLC, there is no employer. You are both sides of that equation. You have to pay both halves, the employee portion and the employer portion. That is 15.3% of your net profit on top of your regular income tax. Here's the thing. For a lot of business owners, the burden of paying self-employment tax makes sense in the early years. It's when the profit is lower and the business is still finding footing, growing the revenue, figuring out the expenses. We just don't have the same net income. But as the business grows, the structure that we started with, it can become very expensive. And the transition to a structure that reduces that burden when done correctly at the right time can be a financially significant decision for you as a business owner. This structure is called the S Corporation. Now let's talk about what an S Corp actually does. I want to explain this as simply and plainly as I can because there's so much confusion out there. I think that confusion really leaves business owners stuck and prevents CPAs from really having this conversation. When your business elects S Corp status, it changes how your income is classified. So instead of your profit flowing as self-employment income, you are now an employee of your business. The first bucket of your pay is salary. As an S Corp owner employee, you pay yourself a reasonable compensation for the work that you do in your business. As an S Corp, you're required to pay yourself the same amount you'd pay for someone else to do the job that you do in your business. That salary goes through payroll, and it's subject to payroll taxes, both your portion and the employer portion, which your business pays. Both reduce the amount of net income that your business reports at the end of the year, both your salary and the employer portion of the taxes. The savings from a self-employment tax rate is real and significant. Now, I do want to address the fact that there are costs to becoming an S Corp. You need payroll, which means a payroll provider, payroll tax, W-2s at the end of the year, and compliance. There's state level compliance requirements in most states. There are setup costs, and there's a real need for bookkeeping and a clean and accurate balance sheet. An S Corp, it's not for everyone. But at the right time, this can be a great strategy for you and your business. So I want to give you the 3 signs to know when you're ready to become an S Corp. The first one is that you've had at least $75,000 in net profit for at least 2 consecutive years. I want to be clear, not revenue, it's net profit. Sales minus cost of goods sold minus operating expenses. We need 2 consistent, strong years at over $75,000. The reason we want 2 years is that we want to see a pattern and not just a single year spike. A single great year does not tell us that your business is ready to be able to sustain the cost of paying you, the business owner, through payroll. There's complexity here and there are requirements. And we want to have that 2 years to show that your business has consistent profitability. It can afford the compliance of becoming an S Corp. Until this point, the math typically doesn't start to work in your favor until we're over that $75,000 a year. Next is that you're consistently paying yourself from your business. An S Corp requires you to pay yourself a reasonable compensation through payroll. If you are not in a habit of paying yourself consistently right now, you are not suddenly going to have the cash or the discipline once you become an S Corp to pay yourself. So we want to see that you are already treating yourself like an employee of your own business before we add that formal payroll infrastructure. It shows us that your business has the cash flow to consistently support paying you through payroll. If you are not consistently paying yourself, just because you could become an S Corp doesn't mean you're suddenly going to have the cash or the discipline to start paying yourself. Don't rush into this decision. The third requirement is that your personal and business finances are completely separate. The commingling, it has stopped. Running personal expenses through your business, using the business account like a personal checking account or the personal checking like a business checking account, this is going to be a problem in any business structure. But in an S Corp, it is a more serious one. We need to have business and personal finances completely separate. Your expenses need to be clearly stated as a business-related expense with proper documentation. This foundation is not in place. The S Corp structure is really going to create more work and complexity. We want to start with cleaning it up first and then having the conversation around becoming an S Corp. If you are sitting here checking all 3 boxes, consistent net profit over $75,000 for more than 2 years, you pay yourself regularly through owner's draws, and you have a clear separation of finances. This is a conversation you should be having now with your CPA, not in December. That way we can start you off on payroll at the beginning of next year and take full advantage of this tax strategy. I want to touch on reasonable compensation because for me, this is a rule that you cannot ignore. When you elect S Corp status, the IRS requires you to pay yourself a reasonable compensation salary for the services that you are providing for your business. This is not a negotiation. This is not Danielle's requirement. This is an IRS requirement. A reasonable salary means that you would have to pay someone else to do what you do in your business. I'd like to explain the why behind this. So why does this rule even exist? Without it, every S Corp owner would pay themselves a $1 salary and take everything as distribution, paying 0 payroll tax. The IRS knows that. They do not want you avoiding the payroll tax for it. So what's reasonable? It depends on your role, your industry, and where you live and where your business is located, as well as your revenue. A reasonable salary for a CEO of a $500,000 a year service-based business in Miami, Florida is going to be different than a business owner in Iowa. There is not one single universal number for reasonable compensation. This is based on your data, where you live, and your role in the business. Here at KSA Tax Partners, every single one of our clients receive a reasonable compensation report in Q1 of each year. We do this so that you know exactly how much to pay yourself and you have an audit proof backup of what you're paying yourself and why. Then during our annual check-in, during this tax check-in process, we will look at your reasonable compensation compared to what you're paying yourself to see if we are hitting those benchmarks and taking advantage of the full spectrum of being an S Corp. So let's summarize this once again. I know that this is a big topic and there's a lot. When you elect the S Corp status, you become an employee of your own business. That means your salary needs to go through payroll. Every pay period, your business pays your salary and withholds income taxes and your half of payroll taxes. Those dollars are then remitted to the IRS on schedule. The business also pays the employer half of the payroll taxes of your wages. You will need a payroll provider. There are amazing, affordable options. We use Gusto with every single one of our clients. It's not an expensive or complicated ad. Your bookkeeper should be helping you coordinate with your payroll provider to make sure that everything is set up correctly and reconciled correctly. At year end, you'll receive a W-2 from your own business. Your salary income shows up on your personal tax return as W-2 wages. You are now a part of your business's expense. This, when we talk about creating a healthy, sustainable, valuable business, having your payroll through your business helps you create a business of value. It shows future banks, lines of credit, investors, maybe somebody who wants to buy your business in the future, that there's a real business here that can afford to pay the business owner or CEO. I know this is a lot of information. That is why we're here at KSA Tax Partners to help navigate you through this strategy to make sure that you feel supported. If your CPA is not having an annual tax check-in with you, I want you to go to ksataxpartners.com right now and book a call so there's still time to support you before the end of the year.